Hello, good afternoon on this very dark, wintry Thursday here in the Pacific Northwest. Hope everybody's having a great new year so far. We really have non-farm payrolls, so jobs and CPI data really driving the markets here this last week. So we're going to kind of break that down in our weekly update this Thursday. My name is Brandon Steele, financial advisor with Mainsail Financial Group just here in Bellevue. And our goal every Thursday is to bring to the market news and data that we're watching and weed out some of the noise along the way. So this week has been very interesting because here we are again between Fed meetings and a lot of data coming out that may or may not drive the Fed's decision. But of course, the market is reacting pretty seriously to some of the data that's come out. And so far, in the good way, but obviously it remains to be seen what the Fed will say when they meet in early February, Feb 1. So let's back up to last week. So last Thursday, we talked about the jobs week that we had and some very important numbers coming out on Friday. So on Friday, we had non-farm payrolls number and the unemployment number both come out. Non-farm payrolls showed that we added 223,000 jobs in the month of December, and that the unemployment rate fell to 3.5%. So here we are, Thursday, obviously the 12th, and really we've seen quite the rally. We saw a rally Friday and quite the rally since on this expectation that this means that the Fed is going to slow or use this as a potential pivot, basically. I have heard a million times that this non-farm payrolls number on Friday was the Goldilocks number that we're all looking for. So if you hear that term, obviously the analogy is that this is just the right number. It's not too many jobs. It's not enough jobs. Just the right number to make the Fed pause, basically, right? Now, here's the thing that I want to share. Although I've heard this a million times this last week, I have also heard this a million times over the last 9 months, 6 months. So while I do agree that the number was just right to kind of open this door, remember, we've been told that there's been a Goldilocks number for 6-9 months now, every single time the data points come out, yet the Fed keeps hiking. Okay, so this is really important to watch. And I'll get into the CPI numbers here in a minute, but remember, inflation is still high. And that is their number one target. Jobs is second. Number one is inflation. Okay, so let's kind of keep that in mind. But nonetheless, we have seen a market rally since Friday on the back of a lot of this jobs data that came out. On Wednesday, which I think added a little fuel to this, on Wednesday, Fed Chair Powell actually refused to speak. And I think that kind of added a little more into the hype. So he spoke, excuse me, but he had refused to speak about Fed policy in that conversation. So that was really interesting. And then here we are today on Thursday. We had CPI numbers come out. And quite honestly, they were right in line with expectations. So it wasn't a surprise one way or the other. It wasn't a surprise to the upside, downside, neither. Core CPI was up 0.3%. Again, right in line with expectations, but actually up from last month, from 0.2% last month. And this brings year over year core CPI to 5.7 and CPI to 6.5%, right? So again, most of this was all right in line. However, we saw the markets rally a little bit off of this news, and I find it interesting. I think there's a lot of speculation going on again here between Fed meetings, which is really important because although the data may be leading this way, remember that happened last time and I think the time before as well. So pay close attention to what the Fed shares in the weeks coming up, but especially, again, the Fed meeting on the 1st is going to be really important, 1st February. And hopefully we're not getting too far over our skis with the incoming jobs and inflation data here. What I want to share as well is that with the CPI number that came out today, by the way, CPI, let me be clear, Consumer Price Index is what CPI stands for. And this is a measurement of inflation, of course. So what I found really interesting in the numbers that came out today is that we still had core CPI up 0.3%. But this is in a period when energy costs were actually down again. So energy costs again down. Today, actually, we're seeing oil prices jump quite a bit, and yesterday as well. So the challenge is that we've got a lot of downward pressure from energy prices, yet CPI is still climbing. So if energy prices pick back up, the question is, what is that going to do to the CPI number? So that'll be really important to watch. And separately, services is a part of that CPI as well. And services were up again 0.5% this last month. So we kind of talked about this move from goods to services, and we're seeing that inflation really take place in that services side of the equation there. All right, so a lot to cover here this week on just two pieces, but they are the pieces. I mean, these are the two things the Fed is watching. So really important information. Wanted to make sure to share with you kind of what's going on, but more importantly, how the market is reacting to it and why. But take that with a grain of salt. The Fed still has a few weeks to decide and to share what they're thinking. So we will see as we get closer to February. Coming up next week, I want to share that the markets are closed again on Monday. I feel like it's just vacation after vacation as far as the market hours go. So markets will be closed on Monday due to the holiday. And then we get retail sales and producer price index next week as well. All right, that's where we'll kind of cap off today's session, but I do want to touch a bit on a question of the week, which is basically New Year's strategies. So here we are moving into 2023. Should we reassess our strategies, or what are we looking at here in the year ahead? And before I share some specifics on that, what I want to touch on briefly is that at the end of the day, the new year doesn't necessarily mean a change in everything, right? At the end of the day, some of the same challenges we've been talking about, the Fed, potential recession, the impact to earnings, all that are still the same as they were 3 weeks ago. So I think that our general view is still the same. However, there are some things that are very different in 2023 versus 2022. So last year in 2022, and I'm going to talk most specifically to stocks and bonds. Last year in 2022, one of the main things that we had discussed and have been sharing time and time again is a bit of a move from growth type of stocks, like your high-flying tech companies, those types of names that we all know very well, to more of a value type of stock, like a Coca-Cola, Procter & Gamble, John Deere, those types of things, right? So that is a big shift that was important last year, and I think is going to continue to be important this year. Second thing I want to touch on is bonds. So in 2022, the writing was on the wall that interest rates were going to rise. And when interest rates rise, bond prices fall. So this is the challenge that many felt this past year, where their bond portfolio was down maybe just as much as their stock portfolio. Now, the way that you can manage that is by reducing how long the bonds are that you hold. You give up some yield probably for it, but you reduce that duration risk, is what it's called, for longer term bonds. So that's something that we did very heavily last year, was really short duration. Now, the thing I want to share this year that's a little different is now bonds are, number one, paying more. So for some of the short duration bonds, you're actually getting paid to hold it much more than you were last year. And second, because rates have gone up so high, there's also potential opportunity in the bond market where if rates come back down, you can experience a little bit of appreciation. So I think the two, as far as stocks and bonds go, I'll share stocks. Again, I think value is an important place to look. And on bonds, it's a much different story than it was last year because of where interest rates are and the risk return kind of spectrum that we're seeing here in 2023. So I hope that's helpful. We'll be back next Thursday to break down retail sales and producer price index. But stay tuned. Obviously, the coming few weeks are going to be very important as we gear up for the Fed meeting on February 1st. Have a great upcoming weekend. We will see you next Thursday.